Hello and welcome back to this channel. 6 golden rules to make you rich using moving average if followed properly. Many students ask me about which indicator you rely on the most. I certainly said based on my past experience, I trust moving average the most without any doubt, because it is one of the most versatile trend following trading indicators I've ever seen so far, and it can be used in many different ways. It is good to know that moving average is used to identify the trend and identify the area of value, which is the key aspect of our trading strategy. But bear in mind, since moving average is a lagging indicator, always use price action when you analyze your market structure. These 6 golden rules are as follows. Rule number 1, always test different moving average and pick the price respect your selected moving average with more touches. Rule number 2, in a trendy market, never enter the market when the price is too far from the market structure. Rule number 3, find area of value on your chart respecting your moving average. Rule number 4, never enter the market when the market is too choppy, since moving average is not performing good in choppy consolidation and range bound. It's good to know that 80% of the time the price in choppy, consolidation and range bound. Rule number 5, always use proper time frame to better time your entry. This way you can maximize your profit. And finally, rule number 6, use your selected moving average as dynamic support and resistance to put your stop loss. This way, you are not going to be discouraged by sudden market reversal. Rule number 1, test different moving average and pick the price respect your own moving average with more touches. Remember, there is no best moving average out there. Rather, you need to find your own moving average that is aligned with your own trading strategy. Now, this is the price trend, TD stock, D1 time frame, Yahoo Finance. The prices, you see the prices going upward and trending nicely upward, all the way up. And here the price is making higher high and also higher low. In the next slide, I'm going to show you which moving average is going to be fit with this price trend nicely. This is the same price trend. I installed these 3 moving average, namely SMA 10, SMA 20 and SMA 50. Now, if I would install SMA 100, it would come around this area. And if I would install SMA 200, it would come around this area, which is too far from this price trend and is no use. So in these three moving average, you see SMA 20, it seemed to be the best fit. Now in the next slide, this is the same price trend, and this moving average SMA 20, it has a touch here, it has the price touch the moving average here, here, almost here, here, and also here. So basically this is the best fit for this price trend. So this is how you can pick your own moving average for your trading strategy. Rule number 1, second example. Test different moving average and pick the one that the price respect your MA with more touches. Now this is the price trend, FRU stock and D1 time frame Yahoo Finance. Here you see the price is trending nicely upward all the way to the top. Now we want to know which moving average respect this price trend. So you try many moving average as you wish. And I tried these three moving average, namely SMA 100, SMA 50, and SMA 20. So these three moving average I installed, and you see that SMA 50 basically respect this price trend the best. Now, this is the same price trend, and this is the SMA 50. You see, it has a very nice touches here, and is excellent touches here, and also here. That is these places that you can attempt to go long, or you enter the market. You can go to a lower time frame and also find nice pattern and formation, or maybe use candlestick mat blending in order to enter the trade. So this is the very nice way to find your SMA in order to fit your price trend. Rule number 2, never enter the market when the price is too far from market structure. This is the price trend FRU stock D1 time frame Yahoo Finance. I installed SMA 50, that is the best fit to this price trend. Now, we all the time suggest don't enter the market when the price is too far from market structure. Look at these places that the price is far from the market structure. This is a market structure. That is dynamic support and resistance. Here the price is too far. Here the price is too far. Here and also here. Let's say if you enter the market here, where are you going to put your stop loss? Below the dynamic support. So if you put your stop loss below dynamic support, you have a really wide stop loss. So when the price coming down, it never trigger your stop loss. So you lose lots of money. But where you really have to enter the market, these places that the price come to the market structure. And if you enter the market, let's say at these places, then you put your stop loss below the market structure, maybe 1 or 2 ATR below the market structure, below the support, the dynamic support. Now, if the price break this support and come down, immediately trigger your stop loss and you are out of the market and you don't lose money that much. So this is the best indication that all the time you have to have in mind. Never enter the market when the price is too far from market structure. Rule number 3, find area of value on your chart to enter or exit the market using moving average. Before I find the area of value on my chart, I always plot my 200 MA on the daily time frame as a very useful guideline to tell me when should I go long or short. I always say that if the price is below the 200 MA, the trend is downward and you should look for short setup. If the price is above 200 MA, then the trend is upward and you should look for buy setup. In order to find the proper buy or sell setup, we have to go to shorter time frame and find a moving average that respect your trend with more touches. We already talked about it. This will help you to trade along the path of least resistance, and since you are trading with the trend, it will actually increase your trading probability. if the trend is upward and the price is above 200 MA and has come close to the selected market structure twice, then the probability to continue along going upward is high, and you can prepare to go long. Here I would like to share with you that always use price action to double check your trading setup with moving average, because although moving average is the best, but it is a lagging indicator. Now this is the price trend, FRU stock, D1 time frame, Yahoo Finance. Now here you see the price is trending nicely, and it come to market structure once, and again trending upward, and it come to market structure twice. Now when you see twice it come to the market structure, then the probability that the trend is going upward is high. So when you enter the market, at least you know that there's a big probability that you make money. So you can enter market after the second coming to market structure, the second touches. So this is how you enter the market. And for exit the market, that's the same scenario when the price is downward or the price is below the 200 MA. Now we can conclude that moving average play 4 important roles in your trading strategy. Role number 1, moving average is used to find the trend direction, whether the trend is going upward or downward using 200 MA. The second role is moving average is used as dynamic support and resistance to identify the area of value of the trend as an entry point. The third role, moving average is used as a barrier that prevents the price going through and bounce back while the market is trending. And finally, number 4, moving average is used as a powerful technique to set your stop loss. This way you do not get hurt financially from sudden market reversal. Rule number 4, never enter the market when the market is too choppy. A choppy market is a market without any clear direction. Choppy market can present themselves after an extended bull or bear market has been in place. Choppy markets are tough to trade. You can see these flat chart patterns in the stock, and the market spend almost 80% of the time in sideways pattern because there is not considerable volatility in the market, and therefore you cannot forecast the behavior of the trend. The flatter moving average shows a flat horizontal line, giving signal to traders that the trend isn't strong and stay out of the market till the volatility is strengthened and the market become tradable. So moving average work best in trending market. Avoid using them in range bound or choppy market. There are special rules to follow if you attempt to enter the range market. This is the price trend, Bombardier stock D1 time frame, Yahoo Finance. I installed SMA 20 in my price trend, and you see that basically the price is coming down, and after that it starts going in a choppy fashion and going sideways. And if you look at this moving average, basically the moving average is flat like a horizontal line. So where you want to enter the market here. When you see the market, there is no indication that where the market is going to go. So you have to wait until the market breaking the straight line and go straight up, go upward or downward. Then you decide, and you can use your price action to enter or exit the market. Rule number 5. What time frame do you use to maximize your profit? A short, medium, and long-term price trend will solely depend on your time frame used, and they are as follow. Number 1. A short-term trend refers to a time frame below H1, like M30 or M15. Scalping, day trading, range and swing trading, and also trend following or fall into this category. In short time frame, traders are trying to use bullish or bearish pattern information, or may use candlestick map blending to find out where the trend might go next with a big probability to enter or exit the market. Number 2, intermediate term trend refer to a time frame between H1 to D1. This is a time period that falls between short and long time frame. Stock analysts are typically referred to as period ranging from 6 months to 18 months. And finally, a long-term trend refers to a time frame above daily time frame. It is mainly used to check the direction of the trend and also refer to trading every few months. For a strong trend, we use 20 MA. For healthy trend, we use 50 MA. And for weak trend, we use 200 MA. Rule number 6, stop loss order using moving average. Professional traders always use moving average as dynamic support and resistance to put their stop loss. Stop loss order is an action that can protect your trading account and do not allow to discourage you by one bad trade quickly and allow you to change your strategy for your next trading attempt. Stop loss can be applied to the following trading while using moving average. Number 1, for short-term trading, use SMA 20 as dynamic support and resistance and put your stop loss 2 ATR below the swing low where the price respect and come close to the market structure. You can also use pattern information and candlestick mat blending and H1, M3 and M15 time frame to better time your entry to maximize your profit. Number 2, for medium-term trading, use SMA 50 as dynamic support and resistance and put your stop loss 4 ATR below the swing low where the price respect and come close to the market structure. Here you can use H1 or H4 time frame to better time your entry. You can also use pattern information or candlestick mat blending to better time your entry and maximize your profit. And finally, number 3, for long-term trading, use SMA 100 or SMA 200 as dynamic support and resistance and put your stop loss 6 ATR below the swing low where the price respect and come close to the market structure. Here you can also use daily time frame or weekly time frame and get help from bullish and bearish engulfing or hammer and shooting star formation to better time your entry. You can also use chandelier stop loss while riding on a big trend. That's all, folks. If you like this video, thumbs up and subscribe. Thanks for watching. Take care and see you next time.